Okay, back with open market purchase. What the Fed does here is that at the trading desk, they announce that they are willing to buy bonds from banks. Banks have bonds on their asset side, government bonds. Why? Because they're going to have a diversified portfolio. They're going to keep some of their depositors' money in government bonds. Why? Because again, they don't want to put all their money into high-risk loans. Diversify, and so keep some of the depositors' money in very safe instruments that pay a little bit of interest and are risk-free. I mean, there's nothing safer than government bonds. So they announce they're going to buy bonds, and they make offers out there, and they keep, say, raising the price until some banks say, yes, we're willing to sell. The Fed can always go higher because, again, they make money. They literally make money. And so they finally get a bank to agree. Let's say Bank of Ontario decides to sell some bonds to the Federal Reserve for $30 million. So what happens here is the reverse of what we just saw. So now they had bonds over here. Now if they sell them to the Fed, they now lose those bonds. The Fed has bought the bonds, so they get a plus $30 million of Treasury bonds on their balance sheet. Now they got to pay for the bonds, the Fed does. And there's two ways the Fed can pay for them. It's based probably on what the Bank of Ontario wants. If the Bank of Ontario would like to have some currency, more currency to further, say, cash withdrawals, ATMs, then the Federal Reserve can create $30 million of Federal Reserve notes right here. Whenever they create Federal Reserve notes, it'll be an additional liability. Remember, Federal Reserve notes are Federal Reserve IOUs. And again, the only entity in the world that treats Federal Reserve notes, dollar bills, as a liability is the issuer, which is the Federal Reserve. Probably, normally, the way they would want to do that is simply to have the Bank of Ontario tell the Fed, just credit our account. We have an account with you. We have so much money. We have a certain amount of money on hand right now in our account. Just add $30 million to it. And so presto, some employee at a keyboard types in $30 million. Deposit for Bank of Ontario. Hits a keyboard, plus, and presto, $30 million is now there that was not there a second ago. And this would be bank reserves, deposit with the Fed. And what can the bank do with that money? They can lend it out to you and I. So now they have $30 million more that was not there a second ago to lend out. And the whole idea is to increase the money supply through the money multiplier and have the money supply grow, which would, some of it would find the money into bonds, and it would drive the demand for bonds up, raises the price of bonds, which drives interest rates down, designed to increase aggregate expenditures. They think the economy is inside the frontier, production possibility frontier. They think unemployment is too high. They think we have a recessionary problem, and so they're going to try to counteract the recessionary problem with monetary policy of increasing the money supply through open market purchase. So down here, open market sale, what it does is it decreases excess reserves. Remember, the money flows out of bank deposits with the Fed, and that means less money for loans. Again, this is to fight inflation. And this will drive up interest rates. And then open market purchase, we just saw, is going to increase bank reserves, to try to get more money into the economy. And this is going to drive down interest rates. And again, this is to fight recessionary problems. Doesn't have to be a full-blown recession. Maybe they think we're going into recession. Maybe they think unemployment is a little bit higher than it should be, and they can drive down interest rates. And that's what the Fed does when they make an announcement. When they announce they're going to drive rates down in the future, that means they're fighting a recession. And when they announce they're going to drive rates up in the future, that means they're going to be fighting inflation. Okay, and this is the most favorite tool of the Fed, the one they use most often. They probably use it daily. And again, this is the way they really conduct mostly their monetary policy. They have two other tools at their disposal that we'll talk about right now. And the first one is a discount rate. Again, that's the rate the Fed charges banks, and this one is actually set by the Fed. The Board of Governors sets the rate. Actually, it allows the 12 district banks to set their own rate, but the Board of Governors has to agree to that, and the Board of Governors wants the rate to be the same in all 12 districts, so they pretty much determine the rate of interest, or sorry, the discount rate. And again, if banks want to borrow from the Fed, this is the rate that the Fed will charge them. Again, this is not the federal funds rate. The federal funds rate is the rate that the banks charge each other, and that's the target of monetary policy. The discount rate is set directly by the Fed, and that's designed to, again, affect bank behavior in terms of affecting bank loans and things like that. So how's the discount rate supposed to work? So the Fed can raise the rate, they can decrease the rate. So if the Fed decreases the discount rate, that makes it cheaper for banks to borrow from the Fed. And they're essentially telling banks, okay, come to us to borrow money. It's now cheaper, and therefore this is designed to get banks to maybe, again, come to the Federal Reserve, borrow more money. And that gives more excess reserves to banks. So banks can make loans with that money, and the Fed doesn't mind that. They drop rates on purpose for that reason. And when they have more money for loans, again, it works the same way. You get a higher money supply in the system, and that would affect rates by going down, and that would increase aggregate expenditures, and again, designed to fight recession. So again, they can do open market purchase to get money directly into banks. They could entice them to borrow more money by driving down the discount rate. If the Fed increases the discount rate, it's the opposite. They want to make it more expensive, and therefore they have less of an incentive to borrow funds, which means they have less of an avenue for excess reserves, designed to have banks have less loans, get loans down. And that means less money creation, means higher rates of interest, designed to decrease aggregate expenditures to fight inflation. Now, having said all that, I also want to add that banks don't usually borrow money from the Federal Reserve. They usually don't rely on the Federal Reserve for funds either way, so borrow money, borrow less. The amount of money that banks borrow from the Fed is very low overall. This is useful if we have a bank collapse, because again, this is a way for the Fed to make loans directly to banks to be lender of last resort. So this also could be a lender of last resort policy, but monetary policy is really designed not when we have a banking collapse, but simply for trying to fight inflation or recession. So if banks don't borrow that much from the Fed, then what's the use of this? Not much. You would call this the weakest tool, because banks don't borrow that much money from the Fed. So this is more of a signal to the financial community that the Fed announces they're going to decrease the discount rate. What they're really doing is telling people, banks mostly, that, you know what, we're going to start using our open market operations to increase bank reserves through open market purchases. So just give you a heads up that you might want to make things more lenient for your customers, maybe try to loan out more money, because we're going to be coming in and increasing bank reserves out there. And then when they announce they're going to increase the discount rate, they're telling the financial community, you know what, you might want to slow down your bank lending. We're going to be using open market sales to be decreasing bank reserves. So you might want to cut back on those loans right now, because we're going to be fighting inflation. So the discount rate is mostly a signal to the financial community as to what the Fed's intentions are using open market operations. Because open market operations really is the main way the Fed actually has a real impact on the financial system. The third tool in the Fed's monetary bag of tricks, or tools, I shouldn't say tricks, and tools for monetary policy is the required reserve ratio, which we've seen quite a bit. And again, this is the percent of total deposits that must be held as required reserves. Now, I'll come back with the next part to do my example down here, but I want to say this tool is a very powerful tool, which we'll see in just a minute, and therefore this is the tool that the Fed uses least often. The last time they changed the required reserve ratio was back in the very early 1990s, and they have not done that since. So this is a tool they have at their disposal. They still can use it if things really maybe become very serious, but it's not a tool they use that often. So again, powerful tool, but the least used one. Okay, let me cut back with the next part, and then we'll go through the example.